It's panic at the top. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, President Biden just authorized the unthinkable. I'm going to show you the controversial move the administration just made and the reason behind it, because many Americans in a certain part of the country are now completely outraged. But this isn't the only problem facing the administration. There's a much bigger one that's going to leave consumers all over the country in complete disarray. Plus, we have a sponsor for today's show. I'd like to welcome Pharma Drug Inc. to the show, and this is a company that has a solution to an existing problem, and you can find them on the CSE under symbol PHRX.CN and on the OTC under symbol LMLLF. And this stock is in a technical bottom right now, and coming out of it, it's a 9-day moving average, crosses upward through the 21-day with tremendous buying support underneath it. I'll show you the setup and why this stock could jump very, very quickly by 50%. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's over to the Department of Energy, where we find out the controversial move that the Biden administration just made. And the U.S. Department of Energy announced the sale of the Northeast Gasoline Supply Reserve. That's right. After we drained the Strategic Petroleum Reserve, now we're draining the Gasoline Reserve. And this is coming as Americans hit the road for the summer driving season. And today, the U.S. Department of Energy's Petroleum Reserves, they announced a solicitation for the liquidation of 1 million barrels of 42 million gallons of gasoline in the Northeast Gasoline Supply Reserve. The solicitation is strategically timed and structured to maximize the impact on gasoline prices, helping to lower prices at the pump as Americans hit the road this summer. And we can note the move to lower the strategic oil reserves had virtually minimal effect, except it drained our reserves. Now we're targeting gasoline prices, and this is going to be insignificant to the overall demand of gasoline, maybe dropping prices by a few cents at best. And this is all being done as a move as consumers are finding themselves more cash strapped than ever. But the sacrifice is coming at a loss of reserves in case something goes wrong, as the Biden-Harris administration is laser focused on lowering prices at the pump for American families, especially as drivers hit the road for the summer driving season. This according to the U.S. Secretary of Energy Jennifer Granholm. By strategically releasing this reserve between Memorial Day and July 4, we're ensuring sufficient supply flows to the Tri-State and Northeast at a time hardworking Americans need it most. But will they even notice it? That's the issue here. The fact is, this is not a significant release that's going to massively lower gasoline prices. It's going to be a sacrifice of our reserves. I would love to know what you think. Does this bother you? Are you outraged, or do you think this is a welcome relief to what is likely going to be higher gas prices at the holiday? The awarded entity is likely made up of retailers and terminals. From the sale will have the fuel transfer to deliver deliberately no later than June 30th, just in time for the July 4th holiday. But what happens after that? Well, anybody's guess, because prices likely to go back up. And here you can see gas prices at the pump this Memorial Day will be the second most expensive in a decade, dramatically above the 10-year average of $2.91. And you can see this is an outright crisis at the White House level, because consumers are now starting to spend less, and they're looking for any form of relief to drive more spending. Because what's going to happen, as of course we see Americans hit the road, spend money on the holiday, it's going to take more and more money away from their discretionary spending. And we can see in this chart here that U.S. regular all formations gas price is near relatively high levels. And again, at a time we have noted that paychecks are shrinking in size, this is just going to pull more money away from the discretionary side of the economy, and that is a dangerous situation. But one chart that people can get behind, that is a chart of our sponsor, Pharma Drug Inc. Let me just give you a preview here. We see momentum rising across the RSI and the MACD, but look at this beautiful bottom here, and you can see it can jump a mere 1 cent to 3 cents, making this a tremendous opportunity. As you see that 9-day moving average cross the 21-day. Stay tuned to the end of the show, because this is a big opportunity to make some money fast. And White House Press Secretary Karine Jean-Pierre said the release of gas from the Northeast Reserve builds on actions by President Joe Biden to lower gas and energy costs, including historic releases from the Strategic Petroleum Reserve and the largest ever investment in clean energy. And yet energy prices remain high, and it's not a policy that's working for most Americans. And this is a challenge because some people believe that this is a politically motivated move. What do you think? As a real reason behind this, according to Zero Hedge, is today they learned that former President Trump's lead over Biden has widened to 13 points in the betting market, the largest difference since mid-March. And meanwhile, the political event prediction website predicted places higher betting odds on Trump than Biden for the first time since March. But will this tilt the scales? Well, probably not, because what we can note is it will only likely bring prices down by a few cents. And what happens after? Well, it's unlikely that prices are going to go down immediately after that. But one of the challenges we're facing now is in the economy. As we see, Target shares tumble after retailer reports caution about weak consumer. Today, Target shares slumped as we've been warning there are problems at the big retailer. As we see, comparable sales have now missed Wall Street's estimates for the quarter that ended May 4th. And this comes as Goldman analysts have warned about faltering low-income consumers in the area. Of course, failed economic policy, but it's not about the president, because we know the presidents have virtually little control over the economy other than, of course, the agenda that they promote. This is all about the fact that financial conditions have tightened due to the Federal Reserve constricting the creation of credit by the commercial banks, which is now causing problems, not just at the lower incomes, but we're seeing even an impact at the higher income levels as we see wealthy people starting to trade down to even Walmart. And comparable sales from stores or digital channels operating for at least 12 months declined a whopping 3.7% in the quarter, and were mostly in line with analysts, but this was a fourth consecutive quarter of declines. And this is not what you want to see in a soft landing or a no landing scenario, as digital sales offset brick and mortar comparable store declines. And here's a big one: lower foot traffic. And why does that happen? Simple, because consumers don't have the money. If you don't have the money, you don't go to the store, because of course we all know when we go to shopping, we tend to buy a few extra things we didn't really plan to. But there's one way to avoid that, and it's not go. And reason why is, well, it's the labor market. Here we can see advanced retail sales. When we talk about, the crisis that this administration is going to face in the coming months heading into the election, it's going to be all about the labor market. Here we look at inflation adjusted retail sales in blue, shown on a year-over-year rate of change against continued unemployment claims. And we've noted that in the past, we've seen this chart where continued claims start to rise, and what happens, it eventually has an impact on retail sales. And you can see that in different intervals of the economy. Now, everyone's been pinning their hopes that this was just a temporary increase in unemployment claims, and what is now seen is a severe impact on retailers. Finally, what we've noted is that consumers have run out of not only money in their savings accounts, they've tapped out their credit cards, they've tapped out the buy now, pay later, and finally the only solution is, well, just cut back the number of visits to the store and watch what you spend. And this is forcing Target, as we've noted, to cut prices. And here we see discretionary spending at Target will be under pressure in the coming months. That's an understatement. Adding demand for appliances and home products are languishing. However, he noted that apparel demand is improving, more likely as people look to try to get a job, want to look nice, but they cannot afford those big ticket items. That's something we're hearing at Walmart, we're hearing at Home Depot, McDonald's, Lowe's. All these major retailers are saying, wait a minute, all of a sudden something has changed in the economy, and now we're seeing it in the housing market today. Existing home sales unexpectedly, I don't know why it's unexpected, because we noted without enough money to fuel the housing market, well, things do change. And this tumbled as home buyer confidence hits record low. And why are buyers not confident? Because they don't have the money and they don't have the credit. It's all about those two items in a debt-based economy. Here we can see U.S. existing home sales on a month-over-month, two back-to-back declines. We're seeing year-over-year sales down 1.9%. And look at this. This pushed the existing home sales back down near COVID lockdown lows. Now you think back, that's when people couldn't buy a home because they were in lockdown, and now people are free to go where they want. but they don't want to buy a home. And eventually, this means prices are coming down. And of course, that also means labor market in the real estate sector. There's a lot of people that are going to hit the unemployment line, as this should really not come as a surprise, because while home builders remain optimistic that things will pick up, home buyers are the least enthusiastic they've ever been about buying a home, going back almost 50 years. And you can't blame them, because in a higher interest rate world, if the economy was indeed booming and we were seeing wages grow as fast as they needed to keep ahead of inflation, and people were getting the hours they wanted to work, that paying higher interest rates wouldn't be an issue. What they're seeing now is they're losing confidence in their job market. They're worried that they're getting a less pay for what they're doing as their hours work go down. This is transmitting back to the housing market as buyers look and say, you know what, I'm not sure I could afford this at a time when builders do what they do best. That's keep building. And here you can see all transaction house prices for the U.S. in blue. This on a year-over-year rate of change against continued unemployment claims. And with no surprise is when people hit the unemployment line, with the exception of heading in a dot-com bubble, because, well, there was a huge demand for housing back then. What happens, a year-over-year rate of change for house prices comes down and occasionally gets into contraction territory, where, mind you, we're at the early stage of heading into a recession. Arguably, we have started it, but just the beginning. This means home prices more likely to enter a contractionary period at some point, particularly as home buyers walk away. But that's not the big problem this administration is facing. As Goldman notes, more dollar strength amid a fight against inflation is coming, and this is dangerous, because the last thing this administration really needs right now is a strong dollar, because what we're going to see are jobs start to leave the U.S. and go overseas as weaker currencies start to attract demand from businesses looking to have their stuff produced by the lowest cost possible. And if the Fed holds steady, but more jurisdictions decide to proceed with domestic easing rather than waiting on the U.S. central bank, then policy divergence would likely keep the dollar stronger for longer. And this is the issue facing the U.S. economy. And we're starting to see this at the consumer level now, that a strong dollar policy is not working. And what we should be experiencing here is money should be flowing overseas, because U.S. consumers feel prosperous. They are not, and that is a dangerous game here, because it means we're likely now in the early stages of a recession. And while analysts see June interest rate cuts for Canada and the UK and the Euro area, nobody is seeing cuts, at least from the Fed, in the near-term future. But a continued softening in the U.S. data over the next 3 to 5 months would allow the central bank to consider lowering borrowing costs at the end of 2024. This by Federal Reserve Governor Christopher Waller. Meanwhile, European Central Bank President Christine Lagarde indicated the cut is probably next month, with a rapid gain in consumer price growth now largely contained. But what you're seeing around the world is other countries are entering a recession sooner and at a faster rate than the U.S. They're going to be forced to cut interest rates to spur demand. The U.S. lagging behind that. Everyone thinks our economy is strong, but the labor market is about to go. And this move, of course, to release some gasoline stocks to drain our reserves is not going to do enough to move the needle hardly at all on the U.S. economy. And here you can see that strong dollar policy looking to cause more havoc than anything. Here you can see advanced retail sales. You can note periods where the dollar goes down in price, and what do you see? Retail sales go up. But you see other periods where the dollar's rising, and well, that means retail sales go down. You see that here again in 2018, 2019. You see a strong dollar here around 2015, 2016, causes retail sales to kind of languish. And here you're seeing it again. And this is dangerous for retailers, because if they don't see demand, well, one thing they're going to do next is cut hours. They cut hours. That means, of course, the spending power of their employees goes down. They're going to cut heads, or as people leave, they're not going to replace them, sending more people, of course, to the unemployment line. And here you can see industrial production, which we know is a big driver of employment in the United States and other countries. Here you can see the dollar goes up in value. What happens? Industrial production usually comes crumbling down, and you can see that effect here again, 2015 through 2016, 2018 through 2020, and now the relatively strong dollar. And if it were to continue to rise as other countries start to cut course, interest rates, well, it means danger for the U.S. economy. It means more Americans out of work as their jobs get shifted overseas. And that's not the only place we note. Of course, we can see strong dollar. Here is the direct impact on the labor market. There are definitely periods where a stronger dollar sends those jobs overseas, and you can see continued claims in blue definitely had higher during some periods, and that's only evident of a weak global economy. That's what gets those jobs headed out of the country, as again, manufacturers look to cut prices in any possible way, just as Target now cutting, of course, prices on 5,000 products, leaving consumers what we're seeing in a cash strap position. But one place that they can find opportunity in a big way, and that is the stock for our sponsor, Pharma Drug Inc. Again, you can find them on the CSE under symbol PHRX.CN and on the OTC under symbol LMLLF. All the information in the comment and pinned comment and description below. As we look here, clinical developments of natural-based medicines and development of biosynthetic formulations of existing drugs. There's already a market for what they're trying to solve, and they are, of course, one of the leaders in this space as a clinical development of reformulated natural-based medicines for the treatment of unmet needs in oncology and infectious diseases. They're developing synthetic formulations of currently existing drugs with a specific focus on the potential third wave of drug policy reform. Again, there is an established marketplace, and what we note is Pharma Drug has the solution. As Pharma Drug provides forward plan to move its patent pending process and formulation of pharmaceutical grade biosynthetic cocaine through the development into commercialization, and this is big. Their primary focus is on developing, manufacturing, and distributing a biosynthetic version of pharmaceutical grade cocaine tailored to meet the increasing demand. So again, the market's already here in the safe supply market with strategic positioning for commercialization and broader market distribution. They are actively exploring diverse paths to revenue, including potential licensing, valuable joint ventures, or the implementation of a royalty model. And here you can see where Pharma Drug Cyreo Therapeutics submits clinical trial application for phase 1 study of patented reformulated cephalosporin. And what we note here is this is a big deal because they're extremely excited to have this on their verge of their next phase of development and evolution, and having the first in-human trial for PD001 can provide the data needed to augment an FDA phase 2 or even phase 3 clinical trial application. And this is a natural product and an approved drug used in more than 70 years in Japan to successfully treat a variety of acute and chronic diseases. In clinical research, it has been shown to exhibit multiple pharmacological properties, including antioxidant, anti-inflammatory, and immunoregulatory, anti-cancer, antiviral, and anti-parasitic effects. This is huge because its low oral bioavailability has represented a major obstacle to realizing its full clinical potential, but that is something that Pharma Drug is seeking to change now. But let's look at the stock because this could change your brokerage account in a huge way. We already noted on the 6-month chart, you can see that beautiful bottoming pattern. Let's zoom in over the last 90 days, and here we can see buyers coming in right around this 2-cent level. And what do we know? The RSI rising as momentum's building. Same with the MACD, positive cross coming out of oversold territory, moving higher. You'll notice that the sellers are up here at 4 cents, but the supply zone we're targeting here right in that 3-cent zone, and you can see here it can move up there in an absolute flash, and that would be, of course, a potential 50% return. Here you can see zooming in over the last 30 days, and what do you see? Buyers right here at that, of course, 2-cent level, suggesting that once all of the sellers are absorbed, then the next quick move is going to be upward right around that 3-cent space. And what this is setting up is a quick potential 50% move. And again, you can find Pharma Drug on the CSE under PHRX.CN and on the OTC under symbol LMLLF. And as always with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.